Hey guys, my name is Daniel Zabala, and in today's video I want to talk about proper diversification as well as show you two examples of two different sample ETF portfolios that I put together and researching for the last year or so. And I want to disclose this first off, is that I'm not suggesting anyone invest in these ETFs or these two particular portfolios. This is merely an example to show you all of how you can develop a diversified portfolio and things to look for, things to consider. So we talk about diversification with your investing or financial endeavors. Proper diversification means investing in different products with different durations and using different strategies. What we're talking about in this video, our strategy is long-term investing, so anything longer than a year. We're talking about our strategy is investing, our duration is long-term, so anything more than a year. And our products, we're going to be talking about ETFs, and we're talking about different ETFs. We're talking about stocks or equities, we're talking about bonds, we're talking about precious metals, and even cryptocurrency a little bit. Now, for example, if we were to look at the S&P 500, okay, the average rate of return over the long term, 20, 30, 40, 50 years, of the S&P 500 is about 9 or 10% rate of return. Okay, some years are really great, really high, 20 or 30%. Some years are really low, 0% rate of return or even negative, right? And everywhere in between, right? So over the long term, you get about 9 or 10% rate of return. An ETF that mimics or does its best to mimic the S&P 500 identically or as close as possible is SPY. SPY is one of the most popular ETFs to follow the S&P 500. The allocation of the individual 500 stocks within SPY are almost identical to the S&P 500. Okay. So, another ETF you could consider investing in is USMV. USMV is an ETF that also follows the same 500 companies as S&P 500, but it diversifies, or it allocates the stocks within the amount to each stock in that portfolio differently than SPY. Okay. What's interesting is same 500 stocks but different allocation. You end up having a higher rate of return with less volatility. With investing for long term, that's really what you want: is higher returns, less volatility, and the purpose of diversification when thinking long-term, a lot of people don't know this or don't think about it this way, but the purpose of diversification is not to maximize returns. The purpose of diversification is to minimize volatility in your portfolio. Because on the contrary, if you want to maximize returns, then actually you want to focus, you want to narrow your focus. The less diversification you have, the higher potential there is for higher returns on your investments. However, you have a lot more volatility in your portfolio. In statistics, we call that the standard deviation, whether it's 1 standard deviation, 2 standard deviations, or even 3 standard deviations, meaning the price swings away from the mean or the average, right? So SPY, again, if the average rate of return in that portfolio is about 9 or 10%, and think about like a roller coaster, SPY, the highs are really high, the lows are really low, right? On average, you're making about 9 or 10% over the long term. Well, USMV, you might make 11, 12, or even 13% on average over the long term. Let's use 12% as an example. 12% rate of return over the long term. Same companies, different allocation, but also because of the allocation, the way it's allocated, the way it's diversified, it's much smoother. The highs are a little bit lower and the lows are a little bit higher. So instead of SPY like this, you have USMV like this, okay? Higher rate of return and you have less volatility. So that is where we want to be, right, with any long-term invested portfolio. So I'm going to show you two portfolios that I've done. One that's really basic and another one that's a little more in depth. And so again, these are just examples, not suggesting anyone invest in specific portfolios, but something to think about and a starting place when you start looking to do your own research to invest on your own. If you want to use ETFs, this is a great starting place to learn. So let's go to the computer and I'll show you these portfolios. All right, so here are the two sample portfolios that I put together. Okay, so I'm going to just show you a brief view of how I ended up calculating these allocations in these, as well as the second portfolio. So what I did first was I looked for, okay, I did some research and I asked myself, are there any ETFs out there that follow the S&P 500 they're going to have that are better than SPY? And better is subjective to what you're talking about. For me, it meant higher returns, less volatility. Through my research, in my opinion, I found that USMV, I like using Morningstar.com, you can find some of the past data, and it has higher returns and less volatility. So in this portfolio, I put USMV instead of SPY. So if we go here, you can see, so what I did was SPY, the average return of the last 15 years was 11.89 with a standard deviation of 11.36%. This is like volatility. Standard deviation, volatility, you can think of them synonymously. USMV, the average rate of return of the last 15 years was 13.06% with a standard deviation of only 8.71% with volatility. That's a lot better. So then I found an asset portfolio comparison basic software on some internet website, I can't remember what it was, and I just plugged in these different ticker symbols, and it gave me a lot of useful information like standard deviation, ultimate correlation, that's the word I was looking for. It showed the correlation between these assets compared to each other, and these are the correlations over here that it populated and generated. So from that, I looked, okay, what has been the average standard deviation or volatility range based on the weighting, and based on beta, and there's all these different factors. This is a theoretical portfolio, mind you. And this is not identical to the one I just showed you because I have FEN in this particular portfolio, but the rate of return was standard deviation. So that's just how I did it, just playing around, doing some basic research. So this is similar to the SPY, but has higher returns, less volatility. This particular ETF looks at only small cap companies, but focuses on low volatility stocks that are small cap versus your traditional small cap stocks are being higher volatility, therefore more risky. This particular ETF focuses on low volatility, small cap stocks. This is long-term U.S. government bonds. This is intermediate government bonds. These are ETFs, so it has diversification built into the ETF over different time frames. This is a TIPS or TIPS, which are a type of government interest-bearing note, if you will, with typically a lot smaller returns, but also less volatility. And this is an ETF that focuses on high-yield municipal bonds, which are like local government bonds that typically have much higher dividend yields, which is pretty nice. And then EMB is an ETF that focuses on, it's a bond ETF fund that focuses on emerging markets. In my mind, if I'm going to put money at risk with emerging markets that tend to be very risky, very volatile, I'd rather go with something that's a little more safe, like bonds, versus some company that, could be bankrupt, whether they go out of business because of business lack of demand for their products, or because just the government is corrupt and decides to put them out of business, because you never know. So again, emerging markets bond fund here, and so that's a little exposure to some international exposure. And then this is a gold ETF, and this is a silver ETF. And so this is just a sample portfolio allocation. You have about 73% stocks, 20% bonds, and then some gold and silver. And then if you want to go a little more in depth, for the second portfolio, I used, on this tab I compared SPY versus USMV to figure, okay, how did these two different ETFs allocate to the 11 different sectors within the S&P 500? Communication, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate, technology, and utilities. So with 2018, well, this was currently, I did this last week, I did this research. So this is the current portfolio allocation within SPY to communications versus USMV, their allocation to the communications sector, right? So it's almost half. And then consumer discretionary, SPY is higher. Consumer staples, though, USMV is almost twice, well, not quite twice as high, but it's higher, right? SPY is higher on energy, USMV is higher on financials, SPY is higher on healthcare. They're very similar on industrials, very similar on materials. Real estate, USMV is much higher. Technology, SPY is higher. Utilities, USMV is higher. So the way they allocate based on sector is different, right? And again, as USMV has higher returns and less volatility, so they must be doing something right. So then I played around, okay, if I'm going to do my own version and invest in these sector ETFs, this is an amount that I want to use, right? This is just something I kind of made up based on my gut feeling, right? There's no real, I have nothing really to back this up except comparing these two ETFs to each other and then looking at their 15-year returns in each sector. That's the only piece of data I used that was different outside of using these set of returns, is what was the 15-year returns on each of these sector ETFs. And this is what I got using Morningstar.com, right? And so then I multiplied the ideal allocation time based on 60% allocation of these into the total portfolio. I know I'm talking really fast. If it doesn't make sense, just watch it. You probably want to watch this video a couple times. But assuming that 60% of my total portfolio is allocated to large cap stocks, right? That's how I got these numbers I did. Okay, if you see 60% or 60 times, what's 60% of 6.75%? It's 4.1%. So that's, and then I did an estimate about 4% of my total portfolio in communications and so forth, right? And so that's how we get to these numbers over here. So this is basically a breakdown of what would be in SPY or USMV with slightly different allocations. Again, the small cap stocks, put 9% instead of 8. Again, the bonds, gold, silver, and then if you want to throw in cryptocurrency like Bitcoin, I wouldn't do more than, definitely not more than 5% of my total portfolio. But for me, if I'm going to do cryptocurrency, I want to keep it small because I like investing in solid companies with long-time track records, long-term successful track records, as well as ETFs that I think are going to be safe. So I might do 1% in Bitcoin. So that's it. Kind of a long, quick explanation, if that makes sense, of these two sample ETFs portfolios. Again, just a starting place, somewhere, something to look at to get an idea of maybe how to go about doing your own research. Again, I just looked at correlation between the different ETFs. And then I also looked at how did SPY versus USMV break down their sector allocation, and then determined what my own might be using the 15-year returns of those sector ETFs. Hope you guys like this video. Please like, share, and subscribe. God bless. Have a great day.